York City, I'm Shauna Smith alongside Brad Smith. This is Yahoo Finance's flagship show, The Morning Brief, the ultimate guide to help you, the investor, make smarter decisions for your portfolio. We're tracking early session volume while bringing you today's top market themes and elevating Yahoo Finance's most popular newsletter.
That's right. Happy Monday, everyone out there. Stock futures taking a bit of a breather at the start of the holiday shortened trading week. Meanwhile, shares of Boeing, they are on the move, ticker symbol BA, after that company announced CEO Dave Calhoun is going to step down at the end of the year. Shares higher 3.5%. We're going to discuss the ripple effects to come.
Plus, the timeline for rate cuts. Chicago Federal Reserve President Austin Goolsbee will be speaking with our very own Jennifer Schaumburger in a Yahoo Finance exclusive. That's coming up in just a few minutes right here on Yahoo Finance.
And a huge day for Yahoo Finance. We're launching our new show, Wealth. Tune in. The premiere is at 11 a.m. Eastern Time. Set your clocks, your watches, your iPhones, whatever you're using. Kitchen counters, I guess, at this point. All your personal finance needs coming forward during that hour. Let's get to it with the three things that you need to know, though. For right now, your roadmap for the trading day. Yahoo Finance's Prof. Supermanian, Madison Mills, and Josh Schaefer have more.
Hey, Brad, yes, shares of Boeing moving higher after the company announced CEO Dave Calhoun will step down at the end of the year. Calhoun's departure comes as the playmaker has dealt with a raft of production issues this year, most notably when one of its 737 MAX 9 planes flown by Alaska Air lost the panel in mid-flight back in January. Along with Calhoun's resignation, Steve Mollenkopf, former CEO of Qualcomm and Boeing board member since 2020, will lead the company's search for its next CEO.
And big tech under fire again. The European Union launching probes into Apple, Alphabet, and Meta on Monday for potential violations of the EU's Digital Markets Act. Under those new rules, the law is designed to prevent tech giants from cornering digital markets by informing customers about alternative offers outside of their main app stores. Apple, Alphabet, and Meta could be slapped with big fines of up to 10% of the company's total global turnover.
In stock futures slipping this morning to start the last trading week in March, but markets are poised to hit a fifth consecutive month of gains, and the S&P 500 is pacing towards double-digit percentage gains to cap off a strong first quarter of the year. It's all about the bulls on Wall Street right now. Oppenheimer's John Stoltzfus upping his S&P 500 target to a street high of 5,500, and Goldman Sachs saying it sees a scenario where mega-cap tech could lead the S&P 500 up another 15% just this year.
Let's get to our top story of the day. Boeing shares moving to the upside, up just about 3.5% in pre-market trading after announcing a major leadership shakeup. The Playmaker CEO Dave Calhoun will be stepping down from the helm at the end of the year. Boeing's chairman of the board, Larry Kellner, also announced that his decision not to stand for re-election at the company's annual meeting in May. Yahoo Finance's Prof. Supermanian, who has been following the Boeing story from the beginning, joining us now here on set. Impressed, at least by the first look of it, shares moving to the upside. It seems like shareholders are encouraged by this news.
Yeah, I hate to say, but we were sort of waiting for this news to happen for some time. I think there was some writing on the wall that Calhoun couldn't survive the Alaska Airlines MAX blowout. It was just the latest. It was so much of a high-profile kind of safety issue that it was just a concern over. Has Boeing actually gotten past its quality control, its safety issues, its production quality issues? And I think that this move was sort of maybe orchestrated by maybe potentially bigger shareholders. The board probably lost confidence. The board, I mean, Larry Kellner also, you mentioned, stepping down there too. He was on the board for over a decade, the chair since 2019, so he's been through it all there. And I think he also was sort of kind of joined with Calhoun as sort of the two biggest guys to sort of come down here. I also want to note that Stan Deal, the head of commercial airlines division, he's also stepping down, and Stephanie Pope, who was head, I think, of Boeing Global Services, will step in for the commercial airlines head position there.
Yeah, it's interesting. I mean, the MAX line has now taken out two CEOs, previously Dennis Muhlenberg and now Dave Calhoun. What do we know about the leadership that they're going to be seeking now for this role, and perhaps the type of person that's fit for Boeing and to really turn things around there?
Yeah, you know, Calhoun leaving, he's also an insider there at Boeing, so maybe the thought is to get someone from outside the company. I'm not sure about that, but I think the two biggest things that I see from like a succession point of view are the person who steps in, do they have the sort of background of turning things around, the ability to have that kind of street cred from an industrial point of view, and then also, are they going to be given a carte blanche to do whatever they need to do?
Which could have major ramifications for the stock and investors as well.
Exactly. Are they going to be able to not only weather the storm of potential downdrafts of the stock, but also the money that needs to be invested to change things at Boeing, maybe reacquire Spirit Aerosystems, as was what was once said, and try to get all that under the same sort of garage or under the same roof to make sure that the planes are back to where Boeing used to be. I think that's the main concern there.
Under the same hangar.
Yes. There we go.
All right. Well, Boeing shares, at least for today, moving to the upside, recouping some of the losses that we've seen since the start of the year. Just some, a long ways to go as we talk about that recovery story. Right, Pras, thanks so much. Well, Atlanta Fed President Raphael Bostic saying that he now expects the Fed to cut just once this year, scaling back from his previous projection of 2 rate cuts. Now, Bostic saying to reporters on Friday that he's less confident than he was back in December that inflation is going to continue to fall towards the FOMC's 2% target. Now, investors await the latest print from the Fed's preferred inflation gauge, PCE, on Friday. Joining us now with more and a very special guest, we want to bring in our very own Jennifer Schomburger. Jennifer.
Thank you, Shauna. Joining me now in an exclusive interview is Chicago Fed President Austin Goolsbee. Austin, thanks so much for joining me. Welcome back to the program. It's great to see you.
Hi, Jennifer. Thank you for having me.
Last week, Fed Chair Powell said during his press conference that despite hotter inflation data in the first couple months of this year, he didn't feel that the overall picture for inflation has changed all that much. Do you share that view?
I think I share that view. I think the big CPI and PCE inflation readings of January remained higher than we wanted them to be and higher than expected in February, but they did come down. They follow on 7 straight months of really quite good CPI and PCE readings. So we're in a little bit of a murky period. The overall, it seems hard for me to view that the 7 months previous to the start of this year were just random. So we're in an uncertain state, but it doesn't feel to me like we've changed fundamentally the story that we're getting back to target.
Setting CPI aside for a second, because that's been running hotter than the Fed's preferred inflation gauge of core PCE. Core PCE sits at 2.8% as of January, and it's been falling by 0.1% every month. We'll get a new reading on that metric this Friday. But do you expect that trend could continue at that pace?
Well, it better, and let's hope we even start speeding up the improvement. We have to. I mean, 2.8 is well above our target, as you know. We're going to get to 2%. We've always known it's going to take place over time. As I say, we're in this murky period where we've got to strike a balance of the dual mandate. The law gives us the dual job of getting prices stabilized and maximizing employment. We've been in a restrictive environment, I think. If you look at the real federal funds rate, that is the rate minus the inflation rate, as inflation has come down, it means that we're in a historically pretty restrictive territory, and it gets more restrictive as we hold the rate steady and inflation comes down. The real restrictiveness goes up. So I think with that level of restrictiveness, you will have to start paying attention to the other side of the mandate, too, if it goes for too long. And you saw Chair Powell discuss the employment side of the mandate at the press conference as well.
I want to come back to that piece of the employment mandate in a moment. But sticking with inflation right now, the committee has projected inflation will end this year at 2.6% on core PCE. That's only 0.2% away from where we sit right now. Yes, the trend could be slower or bumpier than what we've seen over the last several months. But as you said, the inflation picture hasn't changed that much. Given that, what is the prospect that we could be at that level of 2.6% by the summertime?
Well, the one thing to note is that the 2.6% would be averaged for this whole year. So the fact that we got two big readings in January and February mean that for the next 10 months, they will have to be a fair bit lower to get the 2.6 down by the end of this year. So I think there's a big difference between 2.6 repeated for 18 months and what we've been seeing, which is more variability. So we were literally down at 2% for 6 or 7 months at the end of last year. Now we've had two high readings, and we need to see progress in that inflation coming down. That's the foremost thing on our mind. On the dual mandate, where we have missed, as you know, has been on the inflation side. The job market has been quite strong, but the inflation side of the mandate is where we've missed. And I continue to highlight the main puzzle has been about housing, that we've got to get housing inflation coming down closer to where it was before the pandemic. You've already seen goods come down to very, very close to where they were pre-pandemic. Services still elevated, but not that much elevated higher than they were pre-pandemic. And the big outlier has been housing. I do think the market rents show that there is progress to be made, but we have yet to see that in the overall data. So I'm very highlighted about that issue.
So still some room for improvement, obviously, but you did say that we're very restrictive here. So I'm curious, is a June rate cut on the table?
Well, yeah, as you know, I don't ever like tying our hands or signaling that we've made up our minds or that I've made up my mind before the meetings when we're going to get a lot of data between now and whenever that decision has to be made. You've seen the evolution of everyone's thinking and my own thinking. When we had 7 months of 2% inflation or even less, the committee statement ends up being fairly prescient to have added language that says the committee needs to have more confidence that we're on the path to 2%. We then saw this uptick in inflation, and we just got to make sure that we're on trend. I believe that we should never rule out or rule in anything when we've got a whole lot of data to come. And
so, but is
we've
it
got
still
multiple
possible,
meetings
Austin?
And multiple months of data.
So, but is it still possible that we could see June on the table? I mean, or is it off the table?
Look, it's as I say, I don't want to get backed into speculating about what's not even the next meeting, but 2 meetings from now. Everything's always on the table or off the table. It all depends on the data and the conditions, in my opinion.
Let me ask you this. 3 rate cuts have been penciled in by the median for this year. Is that in line with your thinking?
That was in line with my thinking this time as you know, the summary of economic projections is not forward guidance, is not debated. We don't vote, discuss, deliberate on these future meetings. That's the things in the statement are what we discuss and debate. The summary of economic projections are individual projections, which we don't have any debate on. I was at the median for this one, and we'll have to see how the conditions develop on that.
Mm-hmm. Doubling back on what you said in terms of the rate being restrictive right now, I have here in my notes, the Atlanta Fed run some numbers using the Taylor rule. And 3 versions of that rule show that the Fed's target rate should be in the range of 3.9 to 4.7% right now. Do you subscribe to the Taylor rule? What are your thoughts on that? And yes, I know we have room to improve on inflation. What about cutting now?
Well, okay, there's a lot of important issues in that question. Okay, so the Taylor rule is a formula that looks at past history of the Fed and says you plug in the inflation rate, you plug in the unemployment rate, you make some estimates of what the neutral rate of each of those would be, and it kind of spits out here in the past as how the Feds has behaved. I'm a loose subscriber to the Taylor rule, but especially at moments where you've got oddities happening like supply shocks or things that make the current situation quite different from previous times that the economy's been in that circumstance. You just got to be a little careful with being too mechanically tied to let's just do whatever the formula says. There are many Taylor rules, Taylor style rules, let's call them. And some of them are for lower rates, but there are also some Taylor rules that are arguing the rate should be higher. So all of those are inputs that let's pay attention to, but I don't think that a formula should convince us, if the machine says, the Chat GPT tells us we should go cut the rates right now or we should wait until next year to do it. I don't think we should be overly enthusiastic to embrace those rules because we know that 2023, for example, was extremely unusual, really quite substantial drop in inflation with no recession at all, virtually without precedent. Given that we just got through the year in which that happened, let's be a little circumspect of using the old rules to determine what the rate should be right now.
Mm-hmm. And to your point, let me ask you about the pulse of the consumer right now, because we did see retail sales come in a little bit more tepid. What's your sense of the strength of the consumer now and consumer spending as we go through this year? Do you expect any weakening?
Yeah, I think you're right. I like you use tepid. You've seen 2 to 3 months where consumer spending was weaker than it was expected to be. I mean, it's still, the consumer has been a strong part of the economy, and you've seen a lot of growth. I would highlight, it's mixed our picture a little of how much consumer spending and what payroll jobs numbers we can sustain for a given rate of inflation has been mixed a little by the recalculation about immigration. So you've now seen the CBO and others saying there was a lot more immigration last year than they had initially calculated. And if true, larger population, there's no question about it, is going to lead to more aggregate GDP, is going to lead to more aggregate consumption. So I think we still got to get a handle on when we're trying to make calculations that are not per capita, that are about the aggregate. I think we're going to have to pay a little closer attention to what was in the denominator, as it were, not just the numerator.
And let me ask you about the balance sheet, because last week, Chair Powell said that he thought it would be appropriate to begin slowing the pace of shrinking the balance sheet runoff, quote, fairly soon. Do you share that view? And how soon is fairly soon?
Yeah, I don't know the exact date. I do share that view, and I thought Chair Powell's, the second part of Chair Powell's comment is also quite important, which is to say slowing the rate of the balance sheet runoff is not the same question as what will be the ultimate size of the balance sheet. And the issue that we want to pre-announce and approach in a regularized way, a slowing down so we can tell what is the point or where do we think the range of banks having ample reserves is, because that's quite important for our rate control. So I thought the chair was spot on from my view on what should happen with the balance sheet.
And I know that rate cuts are on a separate track from the balance sheet, but would you begin slowing that runoff before cutting rates, or no?
I would keep them totally separate. I think if you remember back in the bad old days, where at every meeting it felt like the market is demanding to know what are you going to do on balance sheet and what are you going to do on rate cuts. That was confusing. It added a lot of volatility, I felt like, and I think it was an accomplishment to get on the balance sheet side, get it separate, and get it on a regularized path. And I felt with the chairman's statement, it was an indication, in my view, of correct policy. I think we want to get on a regularized path, doing it a little slower as we get closer to the point at which the reserves, the point at which reserves are ample.
But real quick, Austin, I gotta go.
We should keep that separate from rates. Yeah.
Real quick, I gotta go. But do you think one would come before the other, or it just depends?
I think it just depends. Like I say, I want them on separate tracks. Our decisions about the balance sheet are not decisions about rate and monetary policy. I think it's important we keep those separate.
All right. Well, Austin, thank you so much for your insight. It's great to speak with you. Hope to speak with you again soon.
Great to see you, Jennifer.
That's Austin Goolsbee, president of the Chicago Federal Reserve. Brad, I'll send it back to you in New York.
Thanks so much, Jennifer. Excellent interview there, and exclusive with Chicago Fed President and Fed Chair, Austin Goolsbee. Well, keeping it moving here this morning on Morning Brief, stock futures, they're edging lower. You've seen it in the corner of your screen here this morning ahead of a shortened trading week and the end of the quarter. My goodness, it's flown. Despite the tick to the downside, markets are on track for 5 consecutive months of gains, and analysts from Oppenheimer see a more bullish path ahead for stocks this year. Here with more, we've got Yahoo Finance's Josh Schaefer to break it down. Hey, Josh, so what are they saying?
Brad, it is the final week of the quarter, and we hit everyone's S&P 500 target for 2024.
Already?
Congrats. Yes, the year's over.
Done.
No, that means they have to come out and just move it higher, right? And that's what we're starting to see street-wide here. So Oppenheimer had been the highest call entering the year, one of the highest calls, tied with the highest call of 5,200. Now John Stoltzfus coming out this morning and saying, well, now that we've reached that target, we simply think stocks go higher from here. Sort of key to this call, a couple things to highlight here, guys. He thinks that we're going to keep seeing a broadening out in the market, and this is going to be a broadening-driven chug higher here, not necessarily a tech bubble style rally. You can see both those calls out there right now as far as the S&P 500. There are people sort of calling for both ways that we could get to see stocks higher here. But the other thing he pointed out that I thought was interesting is simply it's less about the economy surprising him to the upside because he's been in a positive economy camp as a lot of stock market bulls have been this year, but he talked about a capitulation among the bears. Essentially, maybe just the floor is moving up and the floor keeps moving up, right? And at some point, people want to join the party. Mm-hmm. Well, at this point, when you look at performance to the year, where are you going to join the party? Probably in the broadening out, right? You're not going to hop into some of these areas that have already taken off, Shauna, and I think that was one of the bigger takeaways here.
It is certainly definitely worth noting, and also similar just in terms of the narrative that have shifted since the start of the year. A number of the strategists that we've talked to time and time again here over the last several weeks at least have been talking about the broadening out story and exactly what that is going to do here to some of these year-end targets. So that was the latest here from Stoltzfus over at Oppenheimer. But then also Goldman was out with an interesting note, and it's pretty much pointing to a similar type of scenario, just about the fact that so many of their clients are asking, okay, so what's happening now? What are the scenarios around your base case? And they had one scenario that was what? We could see the S&P up to 6,000. On the flip side, we could see the S&P pressured down to just around 4,500.
Right, yeah, it was interesting. Goldman highlighting sort of the question of the moment right now, I think, for a lot of these firms, which is they said one of the most popular questions they're getting right now is what are the possibilities around your baseline forecast? 5,200 is a very popular number right now on Wall Street for the S&P 500, and we're sitting at it, and we have a lot of time left this year. So interestingly enough, we were just talking about that broadening out, right? So broadening out, we're talking about things like financials continuing to perform well. Maybe the Russell 2000 joins the party. If that happens, Goldman said maybe we get to 5,800. What you're looking at on your screen now, though, is sort of the bubble call. So you're looking at market implied long-term S&P 500 growth expectations. If we zoom in on that chart, you can see right now we're at 11%. Look at the tech bubble at 16%. You see that run higher. The post-COVID bubble, which is 2021, we got even more extended in growth expectations. Mm-hmm. Goldman says if we get into an area like that, where we have continued mega cap growth exceptionalism, we're sort of being led by these big tech stocks and people are going to pile into that trade, we could get to 6,000 this year. That's 15% up from where we are now. We should also note, and we'll be digging into this more this week, it's not just Goldman that sees this happening. This is something that Capital Economics has highlighted to us in the past. They think that we could reach 6,500 if we were in sort of a momentum trade. So if we're in a momentum trade, momentum can feed on itself and grow a little bit higher. It'll be interesting to see if that is what we're talking about in 6 months, or if we start to maybe get some sort of pullback, something to slow us down here. It feels like we're just charging ahead.
Yeah, you got to think that scenario at least isn't too likely, but hey, maybe I'd be the one you guys will be having the last time. I don't know. It's just hard to think that we're going to have this massive march forward, just this very, very concentrated group of stocks who are leading the way. They're saying that 6,000 there could potentially be attainable. I don't know. I mean,
they highlighted scenarios where we fall the 45. Two different scenarios where we fall the 4,500 too. Important to note that.
Yeah.
There's still downside risk out there.
Hence why they're right there in the middle of those two scenarios.
Risk is everywhere. All right, Josh, thanks so much for helping us break this down. And this one coming ahead of the opening bell. Another big news item coming ahead of the opening bell. Another crackdown on big tech. This time coming from the EU. The Commission going after Meta, Alphabet, and Apple. The statement says the EU has opened non-compliance investigations under the Digital Markets Act into Alphabet's rules on steering in Google Play and self-preferencing on Google Search. Apple's rules on steering in the App Store and the choice screen for Safari and Meta's is for pay or consent model. So let's just break that down a little bit further here. So for Alphabet and Apple steering rules, what they say is that the Commission has opened proceedings to assess whether the measures that have been implemented by Alphabet and Apple in relation to their obligations pertaining to app stores are in breach of the Digital Markets Act, requiring gatekeepers to allow app developers to steer consumers to offers outside of the app stores free of charge there. And that's something that's come up time and time again and really has been kicked off by some of the companies who were calling about this for years and saying, hey, can you guys look into this? They're taking revenues from us or just borrowing us from the opportunity to realize revenue because of that steering that's taking place.
Yeah, and the impact that this could potentially have on the bottom line, just putting this in perspective in terms of what this means for Apple's business. The EU accounts for about 7% of App Store revenues. Yeah. So it is a significant part of their business. And then, of course, the question is, if this happens over in the EU, what exactly will more of that pressure look like here in the U.S.? We had the DOJ lawsuit, separate issue, obviously, but the DOJ lawsuit last week, pertaining to Apple and some of the concerns there over the monopoly. But then if you move that aside and move also the issues with Alphabet aside, similar sort of scenario there just in terms of their questions about Google Play, but then focus on Meta and what the argument is there, because that's something that also stuck out to me. You have this pay and consent model, which is looking at the ad subscription model versus whether or not you're going to opt in and let Meta share your data. So very separate issues here, but there is pressure across the board on these stocks here in the pre-market. You've got Apple down another 1% potentially. All right, well, coming up, we've got the opening bell on Wall Street on the other side of the break. We'll be right back. And here's the opening bell on Wall Street. We're getting lots of excitement playing out on the floor of the New York Stock Exchange and the Nasdaq. We'll see whether or not this is another record-setting week here for the market. You have the S&P coming off its best week that we saw since the start of the year. And taking a look at how things are starting the week, a little bit of a down note, so a little bit different than how we ended the week last week here, Brad. You have the Dow off just about 0.1%. Taking a look at the Nasdaq Composite, which ended the week at a record high, off just about 0.5% here as we shake out that opening trade, and the S&P also under a bit of pressure. But we got to also start with the big news of the morning, that Dow component Boeing, and you're looking at gains here at the open up just about 3%. And taking a look at that year-to-date look, regaining some of the losses that we've seen since the stock has been under pressure since the start of the year.
Yeah, as we were mentioning at the start of today's show, I mean, this is a huge story. You think about the max line and how tumultuous it's really been for Boeing shares over the years, the hits that Boeing has taken, and now it's taken 2 CEOs out as well with it. And so all that considered, larger question of who steps into the helm there and into the cockpit to really steer Boeing. Couldn't help myself this morning here. Got to start off with some fun, I guess, in the midst of all of this. But anyway, taking a look at the Dow here more broadly, seeing a good mix of red and green as of right now, but some mega cap tech stocks right now down. Microsoft, Apple, we were mentioning the EU Digital Markets Act that's coming after Apple. Amazon was also mentioned within that, very slightly compared to some of the call outs that Apple, Alphabet, and then Meta got as well here. So we're tracking all of those this morning.
You've also got Intel off just about 3.5%. We want to get to the latest on that because Intel and AMD, both of those stocks sinking today after China reportedly planted guidelines to phase out the use of U.S. chip makers in government servers and computers. Now, this is according to a report from the Financial Times. Yahoo Finance's Akiko Fujita joining us in studio with the details on this. Akiko.
Good morning to you guys. Yeah, this certainly points to a further decoupling between the U.S. and China when it comes to critical tech infrastructure. As you pointed out, the Financial Times reporting that China has introduced new guidelines that will phase out Intel and AMD microprocessors from government PCs and servers. The FT reporting the guidelines for this new policy were actually unveiled back in December of last year, ordering government agencies and political parties to require, in their words, safe and reliable processors and operating systems. Translation, only parts from Chinese companies. In all the FT reports, there are 18 approved processors. That includes chips from Huawei as well as state-backed Phytium. All of this, of course, comes as China looks to ramp up their chip production and design in the face of U.S. export restrictions. Remember, the U.S. has already restricted advanced chips as well as chip-making equipment. Now, we should point out Intel and AMD sinking here because Intel, number one, gets 27% of their revenue from China, AMD 15%. There's still questions about how much of that is derived from government accounts. Microsoft's Windows operating system also set to be removed from government devices, at least according to the FT. For Intel, guys, this marks the latest setback. Remember, last fall, they had to unwind or actually abandon this acquisition, $5.4 billion of Tower Semiconductor, which is an Israeli company, but China did not want to approve that. So this really points to these chip makers being increasingly caught in the middle here. But it's going to be interesting to see how quickly China ramps up and how advanced their technology is, because that's been the big question mark. Can they be self-sufficient? China, with this policy saying essentially over the next few years, we're going to move in that direction.
I mean, social media, chips, like it seems like there are more areas that this could broaden out to in terms of industries that could be impacted as a result of what has kind of permeated from a tit-for-tat type of U.S. and China spat that's going on for years now at this point.
Yeah, although, I've been speaking to a lot of China experts about this. Like, how does this broaden out?
Sure.
And it feels like it's still very much focused on critical tech and infrastructure. Social media a little different because of all the data that's collected, but so far it has really been focused on the semiconductor space.
All right, Akiko, thanks so much for tracking this, breaking this down for us this morning. We're also watching shares of Fisker. They're plummeting this morning after the EV startup says the large automaker it was in talks with for a potential transaction has terminated negotiations. Fisker now weighing strategic alternatives, including in or out of court restructurings here. Shares are down 28%. The company has already been going through a massive restructuring of its own business and trying to make sure that they can cozy up to some potential dealers and growing out the dealer network as well. So kind of stepping away from the pure D2C that a lot of, and really spurred by how well Tesla had been able to do in that, moving away from that and now going directly to, okay, what are the distribution partners and channels that we can work with at the dealer model perspective. And if that doesn't help them, you got a question here. Number one, how much longer are we looking at Fisker as a publicly traded company? That is an issue, and any mechanisms that they will need to employ in order to just remain within listing compliance as well. And then two, what sales look like in this near term. I love the names of the vehicles though. Ocean, I mean, how could you not like that?
Yeah, well, hopefully it helps them sell a couple more vehicles here, because clearly they are a very cash-driven company. Lots of questions about what the future is even going to look like here for Fisker following this news. That's directly reflected in the sell-off that we're seeing here shortly after the open, with shares off just about 30%. And remember that this EV maker also announced earlier this month that it was going to be pausing production of its EVs for 6 weeks to raise up to $150 million of funding here after missing an interest payment. So this company is under a tremendous amount of financial strain, tremendous amount of concern going forward about what exactly is going to look like. We know the cost of EVs, what it takes to manufacture these EVs, is very expensive. Yep. Demand simply nowhere near where the expectations were up until this point. And then also the competition landscape getting even more competitive. We've seen price slashing by many of the larger players within this space. So the ability for Fisker to compete here without the partnership of a larger automaker here, there's lots of questions about what even this future is going to look like for Fisker specifically at this point.
Yeah, absolutely. And it doesn't help for the EV industry. That report that just came out from J.D. Power actually this morning, finding out that EV owners were uninformed of faster tire wear, leading to lower satisfaction here as well. So that, another potential hit in the near term on some of the EV demand that we've seen right now.
All right, we'll keep right here on Yahoo Finance. Rates are higher for longer, at least for now. We are going to be speaking with a strategist on why it might not necessarily be a bad thing for the market. We'll be right back. Stocks taking a breather here this morning after reaching record highs last week. Now, investors are looking ahead to this week's PCE data to better gauge the timing of the Fed's first rate cut. Earlier this hour, we spoke to Chicago Fed President Austin Goolsbee in a Yahoo Finance exclusive about his outlook for inflation. Let's take a listen.
We're in this murky period where we've got to strike a balance of the dual mandate. The law gives us the dual job of getting as prices stabilized and maximizing employment.
All right, well, we want to bring in Keith Gangle. He is a Gradient Investments portfolio manager here. Keith, it's great to have you. So we just heard from Goolsbee earlier in the hour saying exactly that on inflation, also saying that he doesn't want to say a rate cut is on the table in June. He doesn't want to say it's off the table in June. So how are you as an investor listening to the latest commentary that we're getting out from Fed officials and how that's affecting your positioning here over the next couple of months?
Yeah, we're certainly listening to the Fed officials. It was a great interview we had this morning with them. Bostic actually came out over the weekend, too, looking for one Fed cut. So that's Goolsbee looking for 3. You're hearing 1. So we're kind of the camp that's going to be more like 2, maybe 3. Going into this year, people are looking for 6 rate cuts. We didn't think that was way too aggressive. Economy's doing very well. Unemployment's low, inflation's coming down. We didn't see the need for a cut, so that's been dialed back down to 3, and we think that could actually be a little less than that. Now, if the economy stays strong, there's no reason to cut, as long as inflation's coming down as well. So those are a couple of things we want to monitor. So we certainly paying attention to a lot of economic activity, but we're also listening to the Fed to see what they're saying.
And so, Keith, with that in mind, what is the playbook for a fewer than expected rate cut scenario for people's portfolios out there?
Yeah, stay diversified. I mean, last year was a story about the Magnificent Seven driving the overall market. The markets are up about 25%. Those names on average are up about 75%. But even outside of those names, the rest of the market was up about 13%. So we're starting to see a broadening out of the overall market, which is a very healthy thing. So we think that should be the playbook going forward. You still want to own these Magnificent Sevens, but you probably don't want to own them all. You probably want to own maybe 4 or 5 and kind of weight those appropriately. And then you also look for other values outside of the Magnificent Seven. And that's what you're starting to see. I mean, you said industrials had a nice run. We think financials are very well placed going forward. We like healthcare as well. Those are kind of the playbook we have going into year end. Now, we think it's going to be choppy. I mean, the markets are up 10% to start the year. So we would not be surprised to see a mild correction here of like 5%. But going forward, we think the markets will be higher by year end.
Keith, what do you think is going to trigger that correction if we do get a correction of about 5%?
Well, obviously, we just finished officially, Q1's down behind the books, but we could see anything. We could see, unemployment maybe ticking up. In a few weeks, we'll actually start seeing Q1 earnings. So if those aren't as good as expectations, that could be the catalyst where we would see a minor sell-off. And that would kind of make sense, that time period. We're in April, kind of May time frame, that the markets pull back a little bit, and then we kind of get that summer rally going.
And then, Keith, just lastly, while we have you here, as so many are trying to think about what that next area to emerge is. I mean, we've heard so much talk coming into this year about small caps and what the weighting looks like for portfolios at this juncture and for the course of this year. Where are you seeing that play continue to either be leaned into or are investors a little bit wary about that right now?
Yeah, small caps, you got to keep an eye on that, right? Everybody's expecting, they haven't performed for the last several years, so everybody wants to get into the area that hasn't performed, and small caps certainly in that list. Value is another name that's a sector that's kind of looked at for underperformance. So of those two, we actually like kind of those large cap value names. We think there's a lot of value there. Like I said, we like some of these financials, and I think large cap value stocks have a lot of those. So that could be an area that does well. As far as small caps, now the economy still has to remain strong, which we think it will, but we think it's going to slow a little bit. In a slowing economy, small caps generally do better when you're starting to accelerate out of the bottom, and we're not sure we're there yet. So we own some small cap names. We're kind of keeping an eye on it, but we're not making a big bet there either.
Keith Gangle, who is the Gradient Investments portfolio manager. Keith, great to see you this morning. Thanks for taking the time.
Thanks for having me.
Certainly. We've got all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Wall Street is getting bullish on media stocks, Citi raising its price target on Netflix, and Barclays upgrading Disney to overweight. Here with the details, Yahoo Finance's senior reporter, Alexandra Canal. Ali, let's start with Disney and what we're learning there from Barclays.
Yeah, well, Disney has been in the news a lot lately due to this proxy battle with Nelson Peltz. That's all going to come to a head next week at the shareholder meeting, April 3rd. But Barclays seeing more room to run here, upgrading shares to overweight from equal weight, and also raising the price target by $40 to $135 a share. Currently, shares are trading around 120, so that implies roughly 15% upside, which is pretty significant considering how much this stock has outperformed over the past year. But the bull case here is that streaming may end up being positive a few quarters earlier than expected. Bob Iger has consistently reiterated that by the end of fiscal 2024, streaming is finally going to be profitable. We also have a few other tailwinds, such as the strike ending, the Hulu consolidation, continued cost cuts, and the analyst here sees that that's going to be more impactful down the line as really Disney commits to this turnaround plan. Now, part of the turnaround plan has been pressured by activist investors, and Nelson Peltz, he's been one of the most vocal, and according to CNBC, he withheld his vote from Disney CEO Bob Iger in that proxy fight, saying he basically implying he does not want him to rejoin the company's board. We'll see. Again, that all comes to a head on April 3rd. He is fighting for a seat at the board along with former Disney CFO Jay Rasulo. But right now, guys, it seems like Disney is in a strong position considering where the stock is trading, considering the positive results we got in their latest earnings report. So we'll see what shareholders want at the end of the day come next week.
Netflix also this morning moving lower by about 0.3%. That also part of this call that's out there too.
Yeah, so Citi has a call. They're raising their estimates to reflect stronger subscriber growth and raising its price target from $555 a share to $660 a share. It's going to maintain its neutral rating. Now, Netflix has been really trying to move away from subscriber ads, and they've sort of been putting the emphasis more on the ad-supported tier along with the password sharing crackdown. So they see that as the key drivers moving ahead here. And Citi really sees more room to run on the subscriber front. And if you think of the recent programming that Netflix has put out there, it's been very successful, especially when we think about international too. I mean, for full year 2024, they're actually going to invest more internationally. They're really emphasizing localized content than domestically. And that's having a boon really when you think about overseas growth and the potential to reach subscribers that are maybe in markets not as mature as the North American market. So a lot of these streaming companies, these media companies, they're putting out their next phases of growth. Right. And it seems like analysts are pretty bullish that as we see that play out, it's going to have a significant impact on the stock price and the bottom lines of these companies.
All right, tracking all the things that are on your screen. Ali, thanks so much.
Thank you.
Appreciate it. We've got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
Welcome back to Yahoo Finance. We are closing in on the end of today's morning brief, and we have a massive announcement. Today is the launch of our new personal finance show, Wealth, and it's hosted by that guy right over there, my wonderful, the best ever colleague, Brad Smith.
The superlatives. How can I ever
we
live
go.
up to that? Well, I'll see all of you at 11 a.m. Eastern Time today. We'll dig into the looming tax deadline, the busy upcoming spring home buying season, and the impact of higher for longer rates on your credit cards as well. But before we get to that, passing the baton for the 10 a.m. show, which will be hosted, of course, by Shauna Smith alongside, I don't know if we have a drum roll in the control room, but oh yeah, we got one here on the desk as well. Coming in at 5'7", born and raised in Southern Florida, parents to this cutie, Billy. Do we have a shot of Billy?
Oh, get
and
him up
our
there.
go-to voice on the floor of the New York Stock Exchange, your next co-host of the 10 a.m. hour, Madison Mills. Yes.
Oh, thank you guys. It's a miracle I didn't fall during that walk-in, so it's already going really
I was
well.
ready for you to do something big, you know? You have
Thought she was going to come in like Deion Sanders,
yeah.
touchdown dance
Listen,
or something.
Where's the confetti when I need it, guys? I'm so excited. Thank you both so much for everything you've done for me in my time here. You know, Shauna, I'm obsessed with you. And Brad, I can't wait for you to tell me that I may never be able to buy a home. I'm excited to tune in
We're
for
going to
more.
make sure. We are going to make sure it's going to get really wealthy during the 11 a.m. hour for sure.
No pressure from you, of course.
I know,
but-
right? I've got to make everybody wealthy out there.
Exactly.
So it's going to happen.
Yeah.
Trust
Oh,
me.
I believe in you
Yes.
wholeheartedly.
And we also had some advice for you as well. My advice,
wow.
because Live, Laugh, Love was taken. May early session market moves be your North Star, and caffeine be your rising.
I love it. Thank
I know,
you.
it's for the astrology lovers out there.
Very Pisces. I love it.
Leo here. I mean, my goodness.
Matt, we are so excited. I am personally, obviously, extremely excited to have you at the desk. Brad, you will sorely be missed in the 10 a.m. hour. But there's so much exciting things happening here at Yahoo Finance. And the fact that we're able to sit alongside each other for an hour today, followed by Brad, helping everyone out there build their wealth, get a little bit richer, helping all of us figure out how exactly we are going to be able to afford homes, our children's college, everything like that over the next several decades. That's all up to you, Brad. Maddie, my advice, it's lame, but it's true. Have fun.
Oh, I love
Right?
it.
We're going to have so much fun here in the 10 a.m. hour and make sure you guys are equipped with what you need to know for the trading day. So lots of exciting things happening.
I'm just seeing the photo of Billy out there. Did we have the shot of the out? Yes.
I would love to see him.
There we go.
With the
Let's
ton out
go.
and everything.
How old
yeah.
is Billy?
That is my son. He just turned 5 and he was adopted from China, moved to New York City about 8 months ago, and he's been in heaven ever since.
Yes.
So
we need
so
to get
have I.
Billy in studio.
Absolutely.
So you guys have all that hopefully to look forward to one day. All right, Brad, time for you to get out of here.
All right, peace. Bye.
All right, well, we have much more of your market action ahead here on Yahoo Finance. Madison Mills will be starting the 10 a.m. hour with me. We'll see you in just a few minutes. Welcome back to Yahoo Finance. I'm Shauna Smith alongside my new co-host for the 10 a.m. hour, Madison Mills. Madison has been all over Yahoo Finance coverage. We are sure that you are very familiar with Maddie. She's been tracking market action on the floor of the New York Stock Exchange, now joining us in studio on a daily basis. Maddie, welcome.
Thank you so much, Shauna. Obviously, I'm so excited to be here, but we got a lot of news today, so we're going to jump right in. We're just about 30 minutes into today's trade, so we're going to take a look at how things are shaping up so far. Stocks trading slightly lower to kick off this shortened trading week. Not a lot of momentum to move off of here, but all three major averages are still on pace for 5 straight months of gains here. So now some time for individual trending tickers this morning, because we have Mizuho Securities downgrading EV makers Tesla, Rivian, and NIO all to neutral. Analysts writing, although they remain constructive on the broader EV landscape, near-term demand and tightening liquidity create challenges coming into next year. Now, EV OEMs face a catch-22, juggling profitability and production ramps as well.
And shares of Lucid skyrocketing after announcing a deal with its majority stockholder here, AR Third Investment Company, to purchase $1 billion worth of newly created convertible preferred stock. Now, AR is an affiliate of Saudi Arabia's public investment fund, and the flow of capital is going to give the EV maker a bit more runway.
And we're also watching Novo Nordisk. The Wegovy maker is buying Cartier Pharmaceuticals for up to $1.1 billion. That acquisition will strengthen Novo's pipeline in cardiovascular disease. Cardio, as a reminder, develops therapies that target RNA to prevent, repair, and reverse heart disease. The deal includes a heart failure treatment currently in phase 2 of clinical development.
And we want to get to some breaking news. New home sales coming out for the month of February, coming in at 662,000. That was a decline of about 0.3%, coming in below the prior reading here. New home sales falling about 2,000 in February from the prior month. Now, the median new home sale price falling 7.6% on a year-over-year basis here to just over 400,500, and average selling price at 485,000. So again, new home sales falling for the month of February, falling to 662,000, which was just below what the street was looking for here, Maddie.
And that's not too surprising given that last month it was a record for new home sales since February of 2023. But interesting to note that Goolsby on our program earlier, speaking exclusively with our own Jen Schomburger, saying that the main puzzle with inflation is housing. He said we've got to get housing under control. Interesting that he was kind of going against the boss, Jay Powell, there with that comment, who last week said, housing, it's no big deal. So it's going to be interesting to see how that continues to shake out, given that these new home sales under estimates, but still pretty strong. We're going to move on here to Boeing, because shares are slightly higher this morning after the announcement of a major leadership shakeup here. The plane maker CEO Dave Calhoun will step down from the helm at the end of 2024. Boeing's chairman of the board, Larry Kellner, announcing his decision not to stand for re-election at the company's annual meeting in May. Mike Boyd, Boyd Group International President, is joining us now to discuss. And Mike, thank you so much for being here. I want to start by just getting your take on this news. Is this what accountability looks like at Boeing?
Well, what it means is they've thrown a couple people under the bus, and they're going to be looking for a new CEO. Calhoun stays for another, 8 months or so. It's a start, but what they need is not just new people, but a whole new philosophy and new strategy. That remains to be seen, and until we see that, you can't be too excited about Boeing right now. We have the same board of directors, and that may mean the same direction. Again, the body count doesn't count. What really does count is what's their new strategy going to be.
Mike, what do you think that new strategy should be? And the fact that this is the beginning of a new phase for Boeing, at least it sounds like it might, at the very least, be a step in the right direction.
It's definitely a step in the right direction to start with. They have to make something of that step. Right now, we're talking about Boeing's manufacturing processes. Okay, fix that. But what are they manufacturing? They're manufacturing a narrow-body aircraft that's really out of date or coming to be out of date. Airbus is now the number one. It's going to be that way for a while because Boeing said we're not going to bring in another new airplane till 2030. Guys, by that time, Airbus will be more than just number one. So we need people who are going to take Boeing, shake it like a dead chicken, and move it ahead into being the leader it used to be. And that's a long way off.
So, Mike, if this is them moving in the right direction, how do they make sure that they nail this process?
What they have to do is make sure whoever they bring in has new ideas, not just a new seat warmer. And again, let's remember, the board of directors has been sitting there for years letting this happen. Maybe we need a bulldozer in that room as well, because they're the ones that are responsible for what's gone on over the last 15 or 20 years that put Boeing behind the curve. So again, we're going to have whole new thinking, not just new people. And that means thinking ahead, planning a new product line, looking ahead to the future in all kinds of areas in aviation. Boeing hadn't been doing that.
When you take into account what we could expect here from the new CEO, we have Steve Mollenkopf here, the former CEO of Qualcomm. He is now going to be chair of the board, replacing Kellner. What are they, from what we know about the makeup of Boeing's board as it stands, or how it will be in just about a month from now, what are they going to be looking for in their search for that next CEO?
One hopes they're going to be looking for someone with more than just a track record, not going as somebody who was at GE or was somewhere else. We wanted to talk about people who will walk in there and say, I know what this company needs, and here's what it is, and can basically put those into words, put those into action. Just getting someone who has a great background doesn't count. We've already had that at Boeing. We need somebody who has a futurist view, and that may mean going outside the industry. It may be staying into it. But we don't want another seat warmer at Boeing for America's good. We need someone who sees Boeing and sees what it can be as a global manufacturer again.
And Mike, following up on that, do you think it's more likely that they might actually go outside of the industry than at this point?
It's possible. The thing is, this is a very specific industry. We're talking about the airliner industry. It doesn't really translate from appliances or translate from, let's just say, medical supplies. It has to be someone who understands the business, understands the time frame involved, understands the competition, understands what the consumer is going to be doing, and also can see into the future. And that's going to have to be someone with a lot of traits we don't see right now at Boeing.
Mike, there's a lot of eyes on Larry Culp this morning after he was able to revise things over at GE. Do you think he would consider this position?
Well, yeah, because he's the one in line to take over the aviation side of GE, basically GE aircraft engines. But GE has a background, too, of not wanting to invest in something until they can see how much money they're going to make from it. In other words, we might be in the engine business, but we're not going to build new engines unless we can make more. We can do something else with the money. Let's hope that doesn't translate from GE aircraft engines into Boeing. We need someone who looks ahead and says, we build airplanes. We cost money to build airplanes. We're going to be the best at it. That's all there is to it. You want to make higher margins? Fine. Go into diapers or something.
Mike, why don't you think? I love your one-liners at the end of answers every time. But Mike, let's talk about the fact that Calhoun is going to be staying at Boeing through the end of the year. Why not leave now?
That'd be my question as well. Why not leave now? Because we don't have a good track record there, very honestly. He's one of a string of people that have been in there who basically has put Boeing into this situation. He probably needs to find, retirement or a new line of work. But he shouldn't be running the show right now because he helped engineer it into this position. So if we put anybody else in there, I don't think it could be a detriment to Boeing. I think really it would be good if Mr. Calhoun moved on to another career.
So given that, how do you think the FAA might react to this news? Do you think it will be positive, even though we do have this kind of interim period with him staying at the company?
Well, let's keep in mind, the FAA is involved in this too. They had oversight, which they didn't exercise. They let Boeing get into the MAX mess and this other mess. I mean, they act like they just came over the hill. They were supposed to be engineering, oversight already. But I think the FAA is going to keep on doing what it's been doing, what it's announced to be done. I don't think they're going to care too much who really is at the helm right now. They're going to be looking at manufacturing processes and other things to keep the public safe.
All right, Mike Boyd, always great to get your insight. Thanks so much for hopping on with us this morning for this breaking news. Boyd Group's international president. Thanks, Mike.
Thank you.
Another crackdown on big tech, this time coming from the EU. The commission going after Meta, Alphabet, and Apple. The statement saying that the EU has, quote, opened non-compliance investigations under the Digital Markets Act into Alphabet's rules on steering in Google Play and self-preferencing on Google Search, Apple's rules on steering in the App Store, and the choice for screen for Safari, and Meta's pay or consent model. So let's talk about what this means for the big tech giant, for Apple specifically. For that, I want to bring in Jim Kelleher. He is Argus Director of Research here to weigh in. Jim, it's good to see you. So I know you have a buy rating on Apple. You had that buy rating, reiterated that buy rating following The legal update that we got from the DOJ lawsuit against Apple last week, how are you looking at the fact that, what does this potentially mean to Apple's bottom line, the fact that now you also potentially have more pressure coming from the EU as well?
All right, so good morning, Sean and Madison. What I would generally say is, we've followed a lot of companies that have spent a lot of time in the courts over the years, such as Qualcomm, and these things do tend to drag on for a long time when the government feels that there are, unfair practices. What I would say is I expect over the long term, and I do expect this to take a while to play out, Apple will negotiate and grant some degree of openness to its ecosystem. At the same time, the immense core of Apple and iOS users is going to stay loyal to the company. That's what I'm thinking right now. The impacts on the bottom line are a little hard to quantify. Just looking at Apple's response to the DOJ complaint, they basically didn't say, we didn't do it, and nor did they say, we're not going to do it in the future. They stood on their principles of how they operate their ecosystem and said, we're always interested in the security of our devices first and foremost. So I would look really at the Apple fundamentals, and I'd be willing to discuss those in a moment as being more indicative of long-term stock drivers.
Well, I want to stay on the investigations for a second because I'm curious if this EU investigation to you felt like a bigger deal than what we saw here in the U.S.
On a preliminary basis, it looks as if they're also going after the fact that, the App Store seems too inclusive, that developers are, undercompensated, that there's an effective firewall preventing the apps from working as well or working outside, the App Store. So I think there will be negotiations all down the line as this thing unfolds, and Apple will give a little, and EU will give a little, and DOJ will give a little, and ultimately, the Apple, the velvet rope will be let down a little bit. The Apple ecosystem will be a little bit more open, but ultimately, I think Apple will do everything in its power, and I think it does have some power to preserve, most of its ecosystem.
Jim, I'm curious, at least with the antitrust case here in the DOJ, there has been some worry starting to trickle through that what Apple might be potentially forced to reveal in terms of their business offerings, because we know they're tight-lipped and we don't really get a good look to that. Do you think they're going to be able to maintain some of those confidential arrangements, or how do you see that potentially playing out?
Again, I think these are things that are a little more on the sidelines. Apple, I don't think there's enormous smoking guns in there. I don't think Apple is behaving unethically. I think they've been operating in the same way they've always been operating. So I'm not expecting big revelations of, that confidentiality is going to unmask some, horrendous goings on. What I'm focused on right now is the fact that Apple seems to be turning around its operations. If you look at 2023, the stock was up 48%, and yet at this time a year ago, in other words, at the fiscal half-year mark, Mac sales were down in double digits in revenue. iPhone sales were down about 5%. Overall revenue was down. Now, I know the street consensus for this year is for slightly down earnings, but if you look at the reality of the first half of this year, you see that Mac sales are up slightly, and you'll see that iPhone sales are up a few percentage points, and they're doing well in every region, excluding Greater China. That's as expected. So I think we're going to see a couple surprise quarters coming forward, and I think we'll do well from here. And the valuation-wise, the stock's trading in line with its 5-year historical multiple at a time when big tech names are trading at huge premiums to where they've traded in the past 5 years.
Right, but it's interesting to note that Apple's stock is down about 8% year to date still, though, Jim. Thank you so much for joining us. We know we got to let you go. Really appreciate it. That was Jim Kelleher, Argus Director of Research, joining us on that Apple, Meta, and Alphabet news. Now, coming up, China blocking more American companies from government devices. We're going to speak to a strategist on what that means for some of the U.S.'s biggest chip makers. That's coming up next.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
Oppenheimer says that the market still has room to run. The team there raising its year-end forecast for the S&P 500 to 5,500. Here with that call is Oppenheimer's chief investment strategist, John Stolfish. John, it's great to have you again. It feels like not too long ago we were saying that, hey, your previous target on the street was one of the most bullish calls on the street. Here we are today, upping the target, the year-end target, to 5,500. So lay out that bull case for us. What's going to keep driving the markets to the upside?
Well, this target is about 8% higher than our 5,200 target, which we put in last December. A lot of people thought we were overly optimistic at that time. And it's just about 5% up from where the market closed on Friday. What backs this upgrade in terms of our target price for the S&P 500 is a number of things, including the Federal Reserve has been very sensitive this Fed funds hike cycle. If you consider they've raised rates 11 times, paused for 6 at high levels relative to where we were before. So they've taken the Fed funds rate from a band of 0.0 to 0.25% to a band of 5.25% to 5.5% within 2 years, and have not pushed the economy into a recession. It's been good for business. If you take a look at the earnings for the S&P 500, third quarter and fourth quarter of last year, the fourth quarter earnings season just ended, okay? In addition to that, you've seen the consumer in remarkably good shape, even with a slowing of their activity to some extent. And on top of that, when you look at the broad area, you see job postings remain remarkably healthy. So a thematic of resilience that looks like it will run further. We think near term, any pullback looks to us like an opportunity for investors to look for babies that have been thrown out with the bathwater, looking to the point of we may even have to raise our target again later this year based on this resilience that has really proven to be even stickier than the inflation rate, because the Fed has had considerable success bringing the inflation rate lower, though still far from its 2% target.
So talk to me then about the babies for a second here. How can our audience of retail investors be looking for the right ones to catch if there even is a moment for a pullback to be happening in this runaway market?
Yeah, well, I'd say one particular area that you want to take a look at is recognizing the fact, just looking at today, for example, where's the selling taking place? And it really is taking place in communication services and industrials and information technology. All sector, the technology sector and communication services, which is predominantly driven by its technology components, those sectors are up 30-some% from the October 27 low of last year. And financials are up 31% from that point as well. Industrials up around 29%. I seem to be having a problem here. Sorry with the phone. I just got to turn that off. Very sorry about that. Usually we find our phones are off for this, and I've been so busy this morning.
Happens
calls
to all of us. No worries.
Institutional calls. Yep, sorry about that.
John, not at all. We have all been there many times before. But John, talk to me about what you were just saying a minute ago, where you see the potential maybe to raise that target once again. How are you assessing those risks? Because we have talked to strategists and so many investors here over the last several weeks at Yahoo Finance. They're concerned about valuations. They're concerned that, hey, maybe we are in this higher for longer environment. That's actually going to put more pressure on equities down the road. Yet it seems like you view more of that risk here to the upside.
Yeah, we would view the greater risk to the upside as sentiment has improved, as sentiment among investors has improved significantly. We've seen massive capitulation by bears since last October, although there's plenty of bears around, okay? But what we would say is the earnings have shown to be remarkably resilient in a period of Fed hike cycle. And in addition to that, technology has enabled companies over the course of the last 15 years, including the great financial crisis and then further with the pandemic crisis, to help companies navigate over troubled water in the economy. It's been rather remarkable. And a lot of that has to do with advanced logistics. And for the consumer, the ability to find competitive sources of buying products as well as a result of all the technology gives them access to. So we think earnings are likely to surprise to the upside. We raised our earnings projection for the year from 240 to 250. It implies an increase of multiple from 21.7 times by year end to 22 times, not much of an increase. But we also see here a shift demographically among investors. It's not all about fear and greed, the hot stock pick of the day, but rather it's planning for retirement by millennials, the generation before the millennials, the Xers, X generation, and the boomers. And then as well as the forward-looking, if you look at the younger generations to the millennials, everybody seems to get the message that Social Security is just not going to be what it once was for previous generations. And in addition to that, you know, the demise or the lack of companies that carry defined benefit retirement plans leads one to conclude that with lifespans, even though there's been slight lowering of lifespans post-COVID, but generally much greater lifespan than previous generations. For people who are going to live longer, you're just going to need to save better, invest better, and that points to stocks from a historical perspective. Past performance, no guarantee of future results, but over many years, stocks have just outperformed other asset classes to against inflation and to take participation within a very prudent innovation that has changed the markets.
John, one thing that has changed here over the last several weeks, we were talking so much about, it almost became consensus that we would have a soft landing. Now there's a little bit more concern about that hard landing scenario. If you, in fact, you have the Fed continuing on this path. What's your assessment of that, and just in terms of how bumpy this landing could potentially be over the next several months?
Well, I can tell you read our strategy, because for a long time we have said that we think that the Fed can avoid a recession, but that a bumpy landing would not be considered to be out of the question. That said, that bumpy landing to us looks a lot less likely as we begin to see the consumer and business, as usually happens when the Fed is having positive effect in bringing down inflation, if not yet reaching its target. What happens is people get more accustomed to higher rates. And in this case, if the Fed funds rate is your benchmark from which everything is derived in terms of lending, 5.25% to 5.5% on the Fed funds rate means it's the end of free money. And that's where we were before, with 0 to 0.25 band on that. Free money, not a good thing. It encourages speculation. When bond issuers have to pay for the privilege of issuing bonds, we think that's a good thing, not only for companies, because they have to be more responsible in projecting their future. In addition to that, it's better for bond buyers who actually receive something in return in terms of a coupon. And that is derived all the way through the banking industry and through all the sectors.
All right, John, we're going to have to leave it there, but really appreciate you joining us. Thank you so much for updating us.
Thank you, Shauna.
Well, we're going to move on because February new home sales coming in slightly lower than the revised January report, but up 5.9% from a year ago. This comes as existing home sales surged 9.5% in February. That was the largest monthly increase in a year. Joining us now to discuss is Lawrence Yun, National Association of Realtors chief economist. Lawrence, thank you for being here. Austin Goolsbee told Yahoo Finance exclusively this morning that housing inflation is still the biggest headache for the Fed when it comes to the inflation picture. Did today's numbers support, refute that claim, or just kind of meh?
We saw the new home sales, newly constructed home sales, reaching the third best since the 2008 foreclosure crisis last year. And this year is still moving above last year. So that is implying that the builders are ramping up construction. We need more supply. More supply will tame down the housing inflation. We need to have more multifamily construction in order to stabilize the rent. I mean, we are seeing rents actually decline in places like Atlanta, Austin, because of massive construction. You don't need a rent control. Every economist knows rent control is terrible policy. Way you get the rent down is through more construction. And on single family side, there is still multiple offers happening. So we need more supply to satisfy the demand.
Lawrence, when it comes to new home sales making up or accounting for overall sales, we certainly did see more of an uptick when you compare it to numbers that we have seen historically speaking. Is that going to be the case once again this year? And I guess how big of a part of that pie do you see home builders playing in this housing recovery?
I think the existing home sales market, which generally comprise 90% of total transaction, it has diminished somewhat because of the lack of inventory. But there are so many homeowners who are stuck in the wrong house. That is to say that in the past 2 years, we have not seen listings pop out for the reason that we know people love their low interest rate. But life moved on. People have additional child in the family. They need larger size home. They need to trade up. We have some retirees who wants to trade down, job switches, which require different commuting patterns. So I think there is a sizable pent-up seller, delayed sellers who've been postponing. And the mortgage rate, the new normal appears to be between 6 and 7%. We are not going to see 5%, 3 and 4% out of the question. So therefore, I think more people are adjusting to the new normal in the mortgage rates, and they will begin to list the property, and more listing is good for the market.
Does that mean that the second the Fed chooses to cut rates, we're going to see this insane groundswell of activity?
We will see increased activity. I'm not sure if it will be a huge bursting, but again, supply is needed because we know that more buyers will be coming onto the market when the rates are lower. But if we have more supply, that will tame down the housing inflation component.
Lawrence, I'm curious to get your perspective on this NAR settlement, National Association of Realtors settlement. Clearly very familiar with it. Just in terms of how much that is going to shift or really shake up the home buying and selling process, what do you think the ultimate impact of that ruling or that settlement, is going to be?
Realtors are small business owners. They're highly entrepreneurial. They will adjust to the circumstance. So I have no worries about that. The worry is about first-time home buyers, first-generation home buyers who are barely scraping for the down payment, and now they may have to come up with additional amount to get the professional representation. So it's an awful news for potential first-generation buyers. They don't have the cash. Their parents are not able to help out because they are first-generation home buyers. And the other group is veterans. There is an explicit mortgage rule that says veterans cannot pay buyer agents. So that is essentially saying to the veterans, you have to do it by yourself, which means they may be taken advantage by the home sellers, or they have to come out of pocket to pay the agents. So realtors will adjust to the situation. I am very concerned with some of the buyers out there, especially first-generation buyers, veteran buyers who may have to struggle through the process. But the market, I'm sure they will adjust, but it's clearly a win for trial lawyers. I don't know how they were able to get the class action lawsuit, but the realtors will adjust. Bad news for first generation and veteran buyers.
All right, we're going to have to leave it there. Lawrence, thank you so much for joining us. That was Lawrence Yun, National Association of Realtors Chief Economist. We're going to have all your markets action ahead right here on Yahoo Finance. Stay tuned for more.
Shares of Reddit pushing even higher today, up another 10% in early action. It's the third day of trading here for the company. The recent gains pushing Reddit's market valuation right around $8 billion. So the question that many investors are asking out there is whether or not Reddit's debut opened up the so-called IPO window for other companies that are looking to go public. Here with more, who better to ask? Yahoo Finance's head of news, Miles Udland. Miles, what do you think? Because there was so much put into, so much hype surrounding Reddit's IPO, clearly outperformed. Does that, though, really signal some of the activity that we could see?
Yes.
Why?
I think that's it. I mean, I think if you look at the way the market is receiving Reddit's IPO, the market is saying we would like more new issues. Now, if you look at Josh's story from last week about why it won't lead to a boom, I think there's some interesting mechanics in there about how much money a lot of companies raised over the last couple of years that makes their need for more capital go away. And I'll just say I know well some of these companies that raised multiple years, like 5-7 years of runway, especially given all the layoffs you have the cover to do right now. So, you don't need to go public to get any of the capital raise. I mean, Stripe last year, maybe end of 2022, they raised money just to pay out early investors and to pay out employees. So they were able to get funding in the private markets to obviate their need to go public. But Reddit right now, the way the market is receiving Reddit, is it's saying if this is even on your roadmap, if you are thinking about doing it, you no longer have the excuse to say something like, well, market conditions make it too hard for us. I think if you're a management team that's been getting any pressure from your investors or your board to consider an IPO and you've been putting it off because you think the market won't be receptive to it, I think that story is over now.
Well, clearly you know the companies very well, Miles. I'm curious, do you think that the factors that are driving the success around Reddit's IPO, specific to Reddit and the fundamentals of that company, what factors are broader market factors that would indicate that other companies will succeed as well?
Well, I think if there's a factor that's specific to Reddit, it's probably our old friend AI. And Reddit basically saying, well, not basically saying, Reddit getting a bunch of money from Google right now to license its whole, basically its back catalog, I guess you could say, of text that's on the internet. Interesting to think that Reddit slang will now be feeding into our AI algorithms, but we can leave that one for another time. I think that's probably the Reddit specific part of it. But to me, ultimately, in a market where you have so few IPOs and there are so few names that have come public in the last 6 months that have this kind of consumer awareness, this is a majority macro play. I mean, I think it's, again, there's all kinds of dynamics in here around the stock specifically, but every banker who is a part of that roadshow, given where it priced, given how it's acted, everyone is on calls today and everyone's in meetings being like, let's go. Literally pounding the table as I just did, because this is the time to go and do it. The Fed has told you rates are not going higher. We have some visibility into what's going to happen there. So the cost of capital, you have a pretty good visibility into what that's going to be. And this is the time to go do it.
So they no longer have an excuse. But then my follow-up question is, how important is that AI component of this, just in terms of resonating with investors out there?
I think that you cannot go public today without an AI play. You have to have something in there that has AI. I mean, you probably can't be private today and stay private and not be what's your AI strategy? I don't think there's a single meeting in the tech space that comes and goes these days without someone saying, what's the AI play? Is you have an AI strategy, this, that, the other. Now, what does that mean? I don't really know. But I think you have to have that as a component of your pitch. Even better if you could have a chips play in here too, we're derivative around NVIDIA or whatever it is. You look at the names on the screen, I don't think there's any question. There's a very robust, obviously two of them are literally AI plays, but Stripe and Shein are not going to have any problem getting the AI story into their prospectus and what they're selling to investors. But you don't have to be nearly this kind of clear with what business line you're in to have some sort of AI play around that as you get into it this year. I think the lesson also for a lot of these companies from 21 as that market cools down is I wouldn't miss the window.
Yeah.
You might have, it might be, a lot of the overhang, look at the volume there in 2021. Obviously there's going to be a hangover, but the market was clear. We did Uber, Peloton, Lyft. We did all these names before the pandemic. Those were 2019 companies, 2019 vintages, let's say. So I think that the market right now is saying 24, 25 need to look a lot more like 18, 19 than maybe had been planned previously.
Makes sense.
Miles, thank you so much. As always, you can find more of Miles' coverage on the Yahoo Finance platform, of course. Stay tuned for all of your markets action right here ahead. You're watching Yahoo Finance.
China blocking the use of Intel and AMD chips in government computers and servers. Eventually, this is a report from the Financial Times on the move aimed at phasing out U.S.-made microprocessors in favor of domestic options. So phasing out there being the key phrase. Now, to break this down and more the investment implications, we want to bring in Kimberly Forrest, Boca Capital Partners founder and chief investment officer. Kimberly, it's great to see you again. So we're starting here with Intel and AMD because two of those names among your top picks are where you are seeing the most opportunity from a portfolio strategy standpoint. When you see reports like this, the escalation in geopolitical tensions, how big of a factor do you see that potentially being on the performance of Intel and AMD here in the short term?
So I think that today's announcement really reflects last week's TikTok announcement from the U.S. And this is tit for tat. So not tick for talk, but, or maybe it is, I don't know. But it really is the Chinese matching the U.S. in forbidding some of its biggest, most used products. And I think it's extremely unlikely that this is actually going to be carried out, if for no other reason, just the volume that AMD and Intel sell into China anyhow. Again, this is only the government PCs, not private PCs. But I will say it does have a chilling effect when Premier Xi looks down on a product and says, we don't want you to buy it. A lot of people in China listen. But again, I think this is all political positioning at this point.
But regardless, this is not the first time that we've heard similar warnings from China. And like you mentioned regarding the TikTok news from last week, a Chinese official saying that China would be biting back, to your exact point there. So I'm curious, is this kind of just the beginning of more regulation that we could see? And to what extent do you think that is already priced into some of these chip plays?
Sure. Well, I think investors really have to be practical and kind of separate the political and what politicians would like to have happen from the practical. Again, I don't think that China has the manufacturing capacity for these specific chips that they're talking about, especially in servers, the higher end chips. Can they find some replacements? Sure. But is this going to be a mass overhaul of how they buy things? On a practical matter, I cannot see that happening. And again, I don't think, does TikTok get shut off in the US? Anybody think that? I think it's highly unlikely. So I think these are really just, politicians kind of talking to each other. And I don't think that it can be, either one of these products can be legislated out of existence in either country.
Kimberly, let's take a step back here because clearly you have the geopolitical risk side of things that are driving a few specific names. And then you also have what's playing out more broadly speaking here in regards to the market action. A lot of that tied to what we're hearing from the Fed, what exactly they're signaling in terms of rate cuts. What is your advice to investors? What should they be doing at this point to position their portfolio, for what could be a pretty bumpy couple of months ahead?
Sure. Well, my advice is always not to look over the short term. The short term it's really true that absolutely anything can happen, but the long term smooths that out. And why does it? If you have a portfolio, regardless of how many stocks are in it, we like generally 30 stocks is a good number, we think. It's concentrated positions, but not overwhelmingly so. Anyhow, I'm getting off the subject here. The best thing to do is to look at long-term trends and how the companies that are in your portfolio can play into them. And I think that is the way to get through short-term choppiness. And remind yourself that there's a lot of reaction that goes on in the short term that doesn't really show up in long-term gains.
So long term then, how big of a risk is NVIDIA's potential pricing power to some of these other players? I think about their latest chip that came in line with its predecessor in terms of pricing. It was pretty moderate. Is that a risk for the AMDs and Intels of the world?
No, I think it's an opportunity because NVIDIA's chips generally are really high priced relative to the competition. And I think that really shows what they can do. They are always at the bleeding edge of technology, which is great. But as AI gets built out, I expect to see companies preferring a little less cost to the NVIDIA chips. And that's going to open it up not just for Intel and AMD, but other providers too. This is a rich space, and I think it's just the beginning of the AI build out. So it's going to attract more companies into this space.
All right, Kimberly, we got to leave it there, but thank you so much for joining us. Kimberly is the Boca Capital Partners founder and chief investment officer. Now we're going to have all of your markets action here ahead, so stay tuned for more. You're watching Yahoo Finance. Former President Donald Trump is up against the clock this morning, facing the deadline to cover the amount of his civil fraud case led by Attorney General Letitia James. Let's bring in Yahoo Finance's Rick Newman to give us the details. Rick, it seems like there's a liquidity issue here. What's going on?
I guess most of us would have a liquidity issue if we had to come up with $455 million, or at least the collateral for that much amount of money. So this is the civil trial in New York State that has actually been concluded, at least the regular trial. It is going to appeal, but in the meanwhile, Trump has to either come up with a bond for $454 million, which he has said is, quote, practically impossible. He can't do it, mainly because he can't provide the liquid collateral that a bond writer would actually require, or he has to come up with the cash, which he also can't do. So he's basically going to ask, this is now at the appellate court in New York State, he's basically going to ask for some kind of relief. And this could go in a variety of different directions. The court could say, nope, we're not providing any relief. The court could say, well, you can provide a smaller amount, or some other kind of finding. Just to remind everybody, this is not one of the 4 criminal trials Trump is facing. This is the civil trial where the judges already found him guilty of business fraud, and that $454 million penalty is basically what the judge calculated Trump saved by deceiving lenders, by overstating the value of his properties and stuff like that. So this is an appellate court right now. It can go one level higher to the New York State Supreme Court. It will not go to the U.S. Supreme Court because it's a state case, not a federal case. But this is just one problem Donald Trump has. And if he cannot come up with the money and the court says you have to pay, I mean, one option is that the prosecutor in this case, New York State Attorney General Letitia James, actually starts the process to sell off some of Trump's properties. So this has massive implications for Trump and his company. But again, this is a civil trial, not one of those 4 criminal cases that is still pending.
And one that we are going to continue to watch here, exactly how all of this plays out. Rick, always great to get you on here. Thanks so much for taking the time.
Bye, guys.
All right, let's do a quick check here of the markets. We are looking at red across the screen with the Dow, the S&P, and the Nasdaq all trading to the downside. You got the Dow off just around 121 points. The S&P falling back from those record levels, off about 0.2%, as well as the Nasdaq. Coming up, a big day, massive day here on Yahoo Finance. We're launching the brand new show, Wealth, dedicated to all your personal finance needs. The one and only Brad Smith has you for the next hour. Stay tuned. We'll see you tomorrow.
Wealth, earning it, growing it, and managing it. More than tracking just the latest market moves. It's more than your favorite trending ticker. One does not simply build wealth without considering the entire financial landscape. It takes a community, and we've built one for you. On today's show, some big financial deadlines are on the horizon, from tax season to student loans. We'll tell you what you cannot forget. And busy season is around the corner for home buyers. We look at the hidden costs to consider. Plus, we look at the impact of higher for longer rates on your credit card. Welcome to Wealth. I'm Brad Smith, and this is Yahoo Finance's newest guide to building your financial footprint. Our personal finance-focused hour is built to help you grow your money. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need, from explainers to jargon busters. We're with you every step of the way. Well, your wealth theme for today: financial deadlines. The big one, first and foremost, taxes. America's tax returns are due in 3 weeks. Even if you get an extension, all payments must still be paid April 15th. We're also talking real estate today, as some key data gives us a read on the housing market ahead of the busy season. And marrying the two neatly, estate planning. We've got everything that you need to know regardless of your tax bracket here today's show. First, let's talk housing right now. For many of us, our home is the most valuable asset we'll ever own. Home price growth is decelerating, but not fast enough. Earlier, in an exclusive interview with Yahoo Finance, Chicago Fed President Austin Goolsbee offered his thoughts on shelter costs.
The main puzzle has been about housing, that we've got to get housing inflation coming down closer to where it was before the pandemic. You've already seen goods come down to very, very close to where they were pre-pandemic.
The U.S. housing market is now heading into its pivotal spring season as home sellers wait for their sweet spot to list properties for sale. We just got a key read on the housing market with February's new home sales. But you might be asking yourself, what do I even mean by new home sales? And how are they different from other home data that we get? Yahoo Finance reporter Danny Romero here with the breakdown as part of Your Money. Hey, Danny.
Brad, new home sales captures the number of newly built homes sold in a given month in the U.S. Over the last year, the new home market has become a dominant player as the resale market has struggled to gain supply. This monthly report from the U.S. Census Bureau and the Department of Housing and Urban Development gives us a pulse of the real estate sector and its broader economic implications. The overall figure serves as a barometer for economists, policymakers, and investors. New home sales represents a small part, about 10% of the housing market, the National Association of Realtors reported, and there's expectations that the newly built homes market will capture a higher percentage of the overall housing market as builders ramp up construction and offer those juicy incentives to attract buyers.
Okay, so Danny, while we have you, now that we know new home sales are ultimately kind of on the move here, and when we think about the numbers in February and what they actually mean for home buyers, put that in context for us here.
Brad, sales of newly single-family homes lost some steam in February, declining 0.3% to a 662 annual pace, the government data showed today. The housing market, though, did get off to a good start this year, but with the Federal Reserve in no rush to lower borrowing costs, rates have actually been on the rise, hovering closer to 7%. And this report reveals really the unbalanced recovery that's happening in the housing market, but it continues to be a bright spot in real estate as inventory lags in the resale market, Brad.
Yahoo Finance's own Danny Romero. Danny, thanks for teeing up the conversation here for us. Let's continue along that same thread here. Buying a new home in the U.S. is an expensive ordeal, and that certainly won't change anytime soon thanks to higher mortgage rates and sticky inflation. Beyond the initial down payment and mortgage, there's a slew of hidden costs lurking in the shadows of home buying. For more on the hidden costs of buying a new home, I'm joined by Jade Warshaw, who is the Ramsey Solutions Master Financial Coach and Debt Elimination Expert. Great to have you here with us this morning, Jade. Thanks for taking the time.
Hey, thanks, Brad. Thanks for having me.
Absolutely. So we were just breaking down some of the new home sales data, but what should buyers and sellers in this market be anticipating going into this pivotal spring buying season?
Yeah, I always tell buyers, make sure you go in with a stacked deck. This is an acronym, right? Of course, D is for down payment. We all know that's coming. And we want to put down somewhere between 5 to 20%. 20% is great because it will help you avoid a hidden cost, private mortgage insurance. And so if you want to avoid that, try putting down 20% or more if you can. And then, of course, E is for earnest money. Yes, we all know we have a down payment, but earnest money is money that we put down usually somewhere between 1 to 3% of the purchase price. And this really just shows that we're very serious about buying this property. The only problem is a lot of people aren't ready to fork over that cash. Yes, it'll be rolled into the down payment once the deal closes, but you need to have that money ready to present before closing. And then, of course, you want to come through with your closing costs. That can be anywhere between 3 to 5%. And you want to keep in mind other hidden costs like appraisals, inspections, even putting up several months of your property tax ahead of time.
So for those who are expected to enter into this housing market, there's a lot of focus this time on first-time home buyers and where they could potentially be looking, whether that's at new homes or whether that's existing. Where are we kind of expecting that to net out going into this season?
At the end of the day, I always tell people, don't let the market determine if you're ready to buy. You determine whether you're ready to buy. And so that might be a new build. A lot of them are they have the ability to offer incentives, right? Whether it's a slightly lower mortgage fee or interest rate. But just be careful because a lot of times it's only for a limited time. And then as time goes on, that interest rate goes up to a normal level. So be careful with that. But at the end of the day, I want to make sure everybody understands the best way to enter into buying a house is to make sure that you've got no debt, you've got 3 to 6 months of expenses saved, and then as a first-time home buyer, if you can scrounge up 5% to put down, I'm very happy for you.
For those who are considering selling their home in order to get into a new home, what are the important things to remember about that settlement and then the purchase towards the next shelter or the next domicile or home or the pad, whatever they're calling it? It's just new.
The crib.
Yes.
That's right. So, Brad, what I would tell people is as tempting as it is when we're looking at new houses on the market and we're ready to sell our house, I would always say if you're going to sell your house and buy another house, make sure you do it on a contingent offer. I do not want people saying, I know that my house will sell eventually. I'm just going to jump into this new house. And if for a while I have to float 2 mortgages, no problem. That is such a scary position to be in. So make sure that you have sold and closed on your previous home before you buy another home. Or if you are going to make an offer on a new home, make sure that it is contingent on the sale of your previous home.
Jade, as we're looking across the country right now and evaluating some of the data and where the hot spots are, where are the hot locations that are seeing the most bids, seeing the most flow into the market as well that you're tracking?
Well, listen, we know that South Florida is popping off. I'm a native of South Florida, and those property rates have gone through the roof. People have doubled the worth of their house. And of course, for the sellers, this is a great time, but especially if you're a seller and you're moving out of South Florida into a less expensive market. But if you're in South Florida at the moment, it's very tough for you because properties are so expensive. Here in the Nashville area, we're seeing the exact same thing. But I like to tell consumers there's a lot of factors that go into this, and I don't want people to get frustrated just because they live in a very expensive market. Think of the market as concentric circles. And as long as you are willing to go into a wider radius, you can always find less expensive properties. The further out of that radius you go, the more affordable properties that you're going to find in that area. So keep searching.
Jade, just lastly, while we have you here, I always do a kind of Command F or Control F for those who are on Macintosh systems. When we hear from Home Depot and Lowe's and their earnings calls and their transcripts come out, I do a Control F for DIY, the do-it-yourselfers out there, because they might be looking to spend a little bit more right now to beef up their existing home so that they can list it on the market. What are some of the hacks to make sure that you get more value when you get that home appraised?
Listen, I think it's so important to make sure that your house is ready for sale. The key thing to remember here, though, Brad, is not to go in debt in order to do so. Try to do these upgrades at the speed of cash. And at the end of the day, if you are a homeowner, the best thing that you can do, remember, home is an asset. It's a way to build wealth. It's a vehicle for you to build wealth. So do your very best not to pull that equity out in the form of home equity lines of credit, HELOCs, that sort of thing, because all you're doing is robbing from your future self. And trust me, when you go to sell, the last thing you want to realize is that you pulled out all of your equity because you needed to, I don't know, give yourself a new bathroom that did not give you the rate of return that you thought it was.
Jade Warshaw, Ramsey Solutions Master Financial Coach, debt elimination expert, and debt-free entrepreneur. All things with the keys of the crib there. Appreciate it, Jade.
Thanks, Brad.
Talk soon. Well, coming up, Reddit shares rising in the wake of last week's public debut, and we want to find out if you're buying in. It's your last chance to have your say in our poll. There you see it right there on your screen, where we ask Reddit users if they plan to invest in the company now that it's public. Make sure to follow us on X, formerly Twitter, to give your vote. We'll get you the answer to our poll at the end of the hour and give you the pros and cons of investing in a newly public company. Plus, more imminently, after the break, tax season is coming to a close on April 15th. Yahoo Finance's Rebecca Chen is going to join us to break down what you need to know about filing. Don't miss our tax time coverage.
It's the end of March and you can no longer procrastinate filing your taxes. But before logging into your tax software or looking for a CPA near you, there are 5 things all taxpayers can do to make this easier. Gather tax documents. Pull last year's returns. Think about life changes. Look for free filings. And of course, if you can't make the deadline, make an extension. These are quick and easy to do items, helping you file the most accurate and rewarding returns while spending the least amount of time and money. Yahoo Finance 2024 Tax Week will guide you through where to start, how to start, and what to do to make filing returns as painless as possible.
April 15th is coming up fast, and hopefully you're aware that's tax deadline day. The government receives nearly $5 trillion of tax revenue in a year, and the IRS will issue close to $650 billion of refunds. But let's face it, sometimes doing taxes just isn't that simple. Yahoo Finance's Rebecca Chen joins us to break everything down here. Rebecca, what do we need to know?
Thanks, Brad. So that's correct. Tax season is only 3 weeks away, or tax deadline is only 3 weeks away. You have to get all of your stuff done by April 15, and it's approaching really quickly. And here we really wanted to provide 3 quick and simple tips to help you get started if you haven't yet. And those are really, before you get started, gather all your tax documents. And also think about if you have any life changes this year. And the last thing is determine how you are going to file your taxes. Now, let me walk through each of them in a little bit greater details. The first one about gathering your tax documents, it's the usual. Gather your W-2s. Whether you have one or multiple during the year, make sure you have all of them. And then your 1099s. These 1099s, they can be from your bank for dividends and interest. They can be from the government, or they can even just be some freelancing income that you've done outside of work. So make sure you have all of these when you are doing your return. And another tip that we have right here is that gather your or have your last year's return. Most people don't really think about their last year's return when they are doing their returns this year, but this is actually a very helpful thing to have while you're doing, because you did all that work last year. You should use it to pivot and help you do this year's return. And that kind of brings me to my next point. When you're looking at your last year's tax return, think about what has changed in your life this year. Did you get married? Did you have a kid? Or did you even buy a cryptocurrency? All of this is very important because they make a difference on your this year's return. So before you get started, really sit down and think about what have you done this past year that is different from previous year and how that can impact your tax return. This is going to go a long way because you don't want to do your return and then remember that, oh, you forgot to claim a trials credit. So it's definitely really helpful to think about all of that before you get started.
Absolutely.
And then the last tip that it's super, I feel like a lot of people don't really think about that, but it's extremely important. And then the last one is really, how are you going to file your return? Now, this sounds a little bit silly because most people probably just sit down, log into the software they used last year, and just go with it. But really think about it. And what I mean is, think about if you qualify for free file. There are a couple different options that you could use to file your taxes for free instead of paying for a software. IRS has a lot of partners where if you qualify, you can file your taxes for free with these software partners. But IRS has also started something called a direct file, and this is still being rolled out. But if you are eligible or if it's something you're interested in, definitely log on to the IRS website and see if you can just do your taxes directly with the IRS without having to go through any commercial software. And after you've done all of this, if you feel like you are just not ready, you don't have time to do it this year, and you want to push it back, do your extension by April 15. And then you can file your taxes for a later date. But one thing to know though, filing your taxes on an extension still means you have to pay on April 15. So just make sure you do that.
All right, they say nothing in life is free, but free filing certainly does sound nice. Rebecca, thanks so much for laying it out for us here. Let's continue the conversation. The deadline for this year's tax season is about 3 weeks away. And with inflation still on the sticky side, some may be struggling to pay. So what is your next best option here? Let's bring in Yahoo Finance's Molly Moorhead joining me here on set to break it down for us. So what is the next best option if you can't pay on the deadline day?
Well, the most important thing to do is go ahead and file. If you owe taxes, you can't pay your bill, you know you can't pay, still file your return. You're going to have a penalty for failure to file and one for failure to pay, but failure to file is worse. It's 5% per month of the unpaid taxes that you owe. So if you have a $500 tax bill, you're tacking on $25 a month every time if you haven't filed your return. So go ahead and file, and then we can talk about how the IRS will help you get that bill paid.
Certainly. So let's talk about those penalties just a little bit more. Molly, what penalties people can face potentially if they don't pay their taxes on time and how they can go about remediating that as well?
So the failure to pay penalty is just 0.5% per month of what you owe. So it's a small amount. It's not, you don't want to be accruing more on this unpaid bill. But if you can't pay, then you have options. You can do a short-term payment agreement that gives you about 6 months to pay off that bill. And then you have a long-term thing called an installment agreement where you can work it out directly with the IRS, and you have up to 6 years. So these are sort of the payment plans, like you would think of, that the IRS offers. In more extreme cases, if there's like some doubt about the taxes that you owe, or if you're in really bad straits and you, pardon me, and you are never going to be able to pay this, the IRS will enter a special plan with you. But those are for the rare cases. If you really just want the IRS off your back, you can pay your taxes with your credit card, take out a personal loan, and then you're in good with the government, but you just deal with your lender to pay off what you owe.
Certainly. And so how does the IRS help taxpayers who may have fallen on a hard time and have other financial issues then?
Well, I mean, they're not gonna leave you alone.
Sure.
So again, file your return, file it on time, but they're gonna give you all these different ways to make good, and not end up with a tax lien or some scary thing like that.
Yahoo Finance's own Molly Moorhead, live in living color in studio with us. Thanks so much, Molly.
Thank you.
Appreciate it. Well, coming up, everyone, forget everything you've been told about estate planning. It's not just for the wealthy. We take a look at how to plan regardless of your tax bracket so you can get the most out of your money. How do you transfer both money and property without getting pummeled by taxes? Whether you're just setting up a standard will or wanting to gift over $13 million, we're diving into the most tax-efficient ways to pass on some of your wealth to others. And we're amidst the great wealth transfer, where almost $84 trillion is trickling from the silent generation and baby boomers down to the younger generations through 2045. That's according to Cerulli Associations. To break down the best estate planning strategy for your tax bracket, we've got Sam Petrucci, who is from NB Private Wealth. Sam, great to have you here with us in studio. First and foremost, for those who hear about the great wealth transfer and are trying to do so aptly and efficiently for their family as well, what is step number one that they need to employ?
Well, thank you for having me, Brad, and congratulations on the new show.
Thank you.
First and foremost, I think it's really important for your entire audience to understand some basic rules. And so if you die in 2024, the estate tax exemption, that is to say the amount that you can pass free of estate tax, is $13.61 million, or roughly $27 million per married couple. Secondly, that number is at an all-time high, primarily because of two reasons. First was the passage of the Tax Cuts and Jobs Act in 2017, which increased that number from roughly $5.45 million to $11 million. Additionally, that number is indexed for inflation. And with inflation running high over the past few years, that $11 million number is now $13.61 million, or again, roughly $27 million per married couple. Thirdly, what's most important is that clients or your audience should understand that that number will revert to prior levels at the end of 2025. And we estimate it will return to roughly a $7 million number per individual, or roughly $14 million per married couple.
Now, it's not just all cash that's getting passed on. Say it's an asset like real estate. What are the key things to remember there as well?
Any type of property. It could be your cash, your stocks, your bonds, your real estate, your artwork, your automobiles. All of that goes into calculating your taxable estate.
And so for different income brackets, they may be saying, okay, how do I make sure that I'm doing it efficiently, whether I'm at the high end of an income bracket or on the lower end of the scale as well?
For smaller clients, I think that you have to stick to the basics. So it's important for everyone to have basic estate planning documents, wills and revocable trust to properly dispose of your estate whenever you die, but also other documents such as living wills, healthcare proxies, and powers of attorney to name agents to act on your behalf if you find yourself incapacitated. Secondly, it's really important to title your assets correctly, and not a lot of people pay attention to this. And I can't tell you how many clients have not properly designated beneficiaries of their retirement plans or their life insurance policies. We encourage clients at smaller levels to also maximize their retirement contributions, which is $7,000 for the year, $8,000 if you're 50 or older. And those clients will often find themselves in a situation where it's important to purchase term life insurance for income replacement purposes. And then lastly, to fund 529 college savings plans to save for their children's future education.
All that said, the exemptions here, a lot of people are going to look for the loopholes, and correctly so. Are there certain exemptions when it comes to this type of planning as well?
Absolutely. And so some basic rules: you can transfer an unlimited amount of property to a U.S. citizen spouse without estate or gift tax. You can transfer an unlimited amount of property to charitable organizations during life or at death without any type of transfer tax. You can pay anyone's tuition or medical expenses directly to the service provider. That's not a taxable transfer. And through it's called the annual exclusion, you can gift $18,000 per year per beneficiary without any type of transfer taxation.
NB Private Wealth, Sam Petrucci. Sam, thanks so much for taking the time in studio with us.
Great to be here. Thanks for having me, Brad.
Absolutely. Well, switching gears here, some turbulence for the aviation industry today we need to keep an eye on. Boeing CEO Dave Calhoun stepping down at the end of this year. It's part of a broader management shakeup at the aerospace company, with the company's chairman and commercial airplane unit. That head's also leaving. It's been a tough year for Boeing. After a panel on one of its aircrafts flew off mid-flight, the airline industry woes won't end there and do not. United Airlines shares lower today as well. This comes as the Federal Aviation Administration increases its oversight of the carrier after a spate of nearly a dozen safety incidents. Now, authorities are considering drastic measures at the airline, like delaying future plans and potentially preventing the airline from adding new routes. That's according to Bloomberg here. Well, for much more on the big questions ahead, firstly, the management shakeup hitting Boeing. What will that ultimately look like, and will it appease regulators? Secondly, Boeing's largest union seeking a board seat. That's according to the Financial Times. So how could that change the aerospace giant's trajectory in the coming year? And thirdly, it's not just the airplane manufacturers we need to watch. U.S. regulators are scrutinizing United Airlines after nearly a dozen safety incidents. Could increased oversight spill over to other big players in the airline industry? Well, let's talk about another major thing that we're tracking here today. Higher for longer is more than just a term for the Federal Reserve, economists, and high-level academics. It matters to all of us in different ways. Last week, Atlanta Fed President Raphael Bostic added fuel to the debate, saying he expects just one rate cut this year. And this came after the Fed held rates at a more than 20-year high. That's between 5.25% and 5.5%. Now, consumers are feeling those rates, especially those with credit card debt. To break down how to deal with high interest rates on your credit card bill, we've got Yahoo Finance's very own Kendall Little here with us. Hey, Kendall.
Hi.
What's the first thing that people need to consider in a higher for longer environment, and how that relates to their credit card spending as well?
Yeah, definitely. So the Fed's decision to keep rates high really means that cardholders are going to see a continuation of the high rates that they've seen kind of accumulating over the past couple of years. So that means it's more important than ever to really pay down your balances as much as possible. Say, for example, you had a 16% interest rate on your card 2 years ago. If that's up to 22% now, then that could mean hundreds more in interest charges per year, depending on your balance.
And so as we're continuing to track this, of course, it comes with the mindset that there has been more credit card debt that's been accumulated here. Where do we sit right now on the kind of scale of history, if you will?
Yeah, credit card debt is definitely on the rise, and that means that, for consumers who do have credit card debt, it's more important than ever to really pay those balances down.
Kendall Little of Yahoo Finance fame joining us here on set. Thanks so much, Kendall. Appreciate it. Well, coming up, fear and money are like oil and water. They don't mix. I'll have a panel of experts joining me to share how you can manage fear and emotion when investing. Also ahead, an introduction to Maconomics with one of our favorite influencers, Ross Mack. Here's a little taste of what you can expect.
First things first, a tax refund isn't just a magical bonus that the government was feeling generous about giving you. It was actually your money in the first place. You were just paying the government too much in taxes the prior year. Yeah, guys, you were giving the government an interest-free loan. So before you try to take that money and actually make a real big purchase, you should ask yourself, would you have made that purchase the year prior? Exactly. So let's actually talk about what you should do with it.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
The tax man cometh. Tax season is well underway. In fact, you have a little less than a month left until that April 15th deadline to file your 2023 taxes. So we want to get some tips for all the late filers that are out there. Yes, if you're filing right now, you would probably be considered late. Joining me now to help simplify your finances is Maconomics founder and personal finance expert, Ross Mack. Ross, great to see you. Let's start with those self-employed folks that are out there. What should they be writing off in their taxes?
Brad, thanks for having me. When it comes to self-employed individuals, you got to understand there are a number of write-offs that are qualified that the government allows you to write off, right? First things first, your startup and your operational costs, right? It costs in order to start your business, as well as you got to understand that everybody lived through the COVID lockdown. Well, guess what? Many people, most entrepreneurs actually live in their home, and guess what? They have a home office. So you have that home office deduction. You also have marketing costs. You have travel costs, vehicle expenses. But I would obviously say, consult with a CPA, a qualified, CPA.
I'm going to ask that CPA if I can count me cooking for me as a personal chef, a live-in chef. I don't know. I might have to pay myself for my services. Once our viewers, though, file their taxes, if they do receive a refund, what should they do with the money?
I love that question, right? I think, one, you got to first understand, right? A tax refund isn't just a magical bonus the government gave you. In fact, it was your money that you were just paying too much to the government the prior year. But when it comes to this question, the very first thing I always want you to do is make sure you don't have any bad debt. And what I mean by that is that 20+% APR credit card that you have. Secondly, after that, assuming you don't have any credit card debt, the next thing I want you to do is ensure that you have a fully funded emergency fund. And then thirdly, I would recommend starting to invest. And when it comes to investing, you could ask Warren Buffett, you could ask myself. I think the very first investment a person should have is one that is the most diversified, that being index funds, right? S&P 500, Nasdaq, et cetera.
And with that investment mindset as well, what is the time horizon that you typically tell folks to consider?
The idea is when you buy an asset, you want to be holding it for 5+ years, right? Because you got to take into account your timing, right? One of the greatest things they say is, you can't time the market. Instead, you want to focus on time in the market. So when you're buying an asset, you're looking to be a long-term holder. So I look at it for 5+ years. When I buy an asset, right, I'm trying to hold it until I'm getting ready to retire.
Ross Mack, thanks so much. Appreciate it.
Thank you.
Let's switch gears here and talk Reddit. Reddit shares moving higher in the wake of last week's public debut. But what are some pros and cons of investing in a newly public company? Yahoo Finance's Rochelle Akufo is here with a breakdown of what you need to know before investing in an IPO. Hey, Rochelle.
Indeed, and Reddit's a great one to think of because this is really a community event here when it comes to investing. But just because you like a company doesn't mean you should invest in it. So let's break down some of the top 3 things you should think about. Number 1, do your research on the company before you even think about venturing into this space. Now, a company going public doesn't necessarily make it a good investment. A good place to look are SEC filings or platforms, of course, like Yahoo Finance, where you can break down all sorts of things, including valuation, the share price, the business model, the financial health, and the growth potential as well. And something else that you can also perhaps see a little bit more about the company is what's called an IPO roadshow. So before a company IPOs, they go to a few select major cities and they highlight, they really try and sell you on some of the best things about the company. You get to see how it works in person. And you also get a look at some of the key personnel involved in this as well.
So
one thing that's interesting, though. Oh, yes, Brad.
Yeah, no. Continue, number 1. But perhaps let's go a layer deeper here. Should investors expect some volatility then?
I mean, you definitely should. It is usually par for the course that there is going to be some volatility because the markets need a bit of time to digest if the stock is priced correctly. And that can depend on supply and demand. That can also depend on macroeconomic backdrop as well. So that's something to keep in mind. And also, you sometimes can look out for some big whale investors here. We saw Kathy Wood, noted growth investor there, bought about 10,000 Reddit shares across her 2 ETFs. But you do have to keep in mind that this is a risky investment. There is going to be some volatility, not just in the short term, but also when the so-called lockout period ends. That's usually up to about 180 days. where a lot of the initial people who bought these IPO shares are now able to sell them. So expect some volatility, and just keep in mind what this means for your overall financial plan. Don't go putting your whole tax refund into Reddit if that's not where you need to be. And most importantly, check that you're eligible. Just because something has IPO doesn't mean you're eligible. Find a good brokerage firm which allows for IPOs, and sometimes there could be minimum requirements in terms of the minimum amount of money you should have or the number of transactions. So make sure you choose the right brokerage firm. Some of the names, Vanguard is usually a typical one, or Fidelity, or perhaps if you like your online versions, you have things like Robinhood or E-Trade as well. But just keep in mind, obviously this is one part of your portfolio, so don't put all your eggs in one basket. Don't get caught up in the FOMO. Do your homework. That is much more important. Fundamentals over FOMO, Brad.
Just lastly, while we've got you here, Rochelle, we teased it at the top of the show. We can't let the viewers go without letting them know the results of the poll. So what do we got?
You'd be surprised. So we actually did ask current Reddit users if they were willing to invest.
Okay.
It was an overwhelming no. And that was actually quite surprising, because there was some buzz about, some of these, the affinity shares that were available for people who were like big users in Reddit, but 68% saying, nope, I don't plan to. Just goes to show, just because you like a company and use its products and services doesn't mean you want to invest in it. So take everything with a grain of salt, Brad.
Oh, sad snoo, sad snoo. It wasn't even close, those numbers here. And of course, Snoo is the mascot, the famed mascot for Reddit out there, folks, who we saw ringing the opening bell. Rochelle, thanks so much. We appreciate it. Coming up, everyone, we'll dive into why fear and emotion, even more than the Mariah Carey emotion, are the enemies of long-term investing. We have two great panelists to tell you how to overcome those obstacles. Much more on Wealth after the break. You're watching Yahoo Finance.
It's the end of March and you can no longer procrastinate filing your taxes. But before logging into your tax software or looking for a CPA near you, there are 5 things all taxpayers can do to make this easier. Gather tax documents. Pull last year's returns. Think about life changes. Look for free filings. And of course, if you can't make the deadline, make an extension. These are quick and easy to do items, helping you file the most accurate and rewarding returns while spending the least amount of time and money. Yahoo Finance 2024 Tax Week will guide you through where to start, how to start, and what to do to make filing returns as painless as possible.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
Now, if you're going to use your tax refund to help build your investment portfolio, what is the best way to go about it? Well, our number one tip, keep fear and emotion out of it. At the end of the day, markets are made by human beings and largely driven by sentiment. So how do you keep a steady head in this investing cycle? Here to tell us, we've got Neil Mukherjee, who is the TIAA Chief Investment Officer of the Wealth Management Division, plus Michael Gayed, who is the Title Financial Group Portfolio Manager. Thank you so much, both of you, for taking some time here in studio with us. I mean, this is complex because obviously you have some emotion when it comes to your portfolio, but how do you go about removing fear and emotion from your investment decisions? Michael, I'll begin with you.
Well, don't follow my X account
Okay.
because I tend to be pretty emotional in my posts. Look, I think it's important that we're distinguishing between short-term and longer-term, short-term trading, longer-term investing. I think the number one thing to remove emotion is to not look. Right? Meaning there's all kinds of studies that show that when people look at prices more often, they're tempted to overtrade. Mm-hmm. There's all kinds of studies that show that those that tend to look at their portfolio quarterly as opposed to monthly or daily tend to have better longer term performance. What causes people to be emotional from a fear and greed perspective is real-time pricing. Right? And I think to the extent that investors can try to remove that and remove social media as much as possible, or at least have a dedicated time frame under which you actually look at that information, you're probably going to be better off that way.
I mean, Neil, there is so much emotion that gets kind of pulled into this environment when you hear about some of the massive run-ups, whether that's driven by themes like generative AI. How can you be more calculated even with those decisions that you're making along the way?
Yeah, well, I would say that number one is time in the market is more important than timing the market. I think for an average investor, one of the mistakes that they make is they let fear and emotion, to your words, get in the way of prudent portfolio management. And what history has shown is if you can just stay invested in the market over the long term, your returns are much better. So just to give you an example, if you stayed in the market over the last 20 years, your average annual returns are about 10%. But if you miss the 10 best days in the market, your returns drop to about 5.5%. So it's half that. And then if you miss the 20 best days, the returns drop to 2.8%. So the number one thing you can do is stay invested in the market and have a financial plan which is in sync with your goals, your financial goals, your risk tolerance, and your time horizon.
You know, there's a tool out there that a lot of people commonly call the fear gauge index, which is the VIX, SIBO's VIX. And I mean, we're sitting at like 13 right now. So there's not a lot of fear that's out there in the market right now. But for investors who are trying to best anticipate what the next major opportunity is or where they're using a tax refund and those hard-earned dollars that they're getting back now from the government and putting that back into their portfolio strategy, what do you remind them along the way when they are allocating some of that to a major investment, Michael?
Well, there's fear of missing out, right, which is the fear that's happening now.
FOMO.
I will say, by the way, that point is very valid about the 10 worst days, 10 best days. The interesting thing about that is that if you remove the 10 best days and 10 worst days, you have the same return as buy and hold, because those extreme days happens in periods of volatility when emotion and overtrading tends to happen. So I think you're going to look at from the perspective of where do you allocate. Know thyself, which means that you got to know how you're going to respond to volatility. If you're going to respond poorly to volatility, you might want to be in low volatile investments. Avoid the fear of missing out. Avoid the FOMO that causes people to then chase at the wrong time. And consider that, you know, the reality is markets, yes, they tend to move over the long term, but the long term is very hard to achieve. The joke about buy and hold is that very few people actually hold.
We're getting into a critical time where there's going to be a great wealth transfer that we were discussing with one of our guests earlier as well here. And that could also mean a great wealth transfer in ideologies of investing. Where is the biggest shift that you're anticipating there, Neil?
Yeah, I think you're absolutely right. First of all, investors generally are feeling quite nervous. You talked about tax refunds. And it's prudent. In a way, you can understand why investors are nervous because asset prices have gone up quite a bit. But what I would remind investors is that volatility is quite common in the stock market, right? So 5% like pullbacks happen on average 3 times a year. 10% like pullbacks happen once a year. And volatility is that invisible hand which shakes off the excesses in our market-based economy so that on the other side, better capital allocation decisions are made. So to your question as to what to do with those tax refunds, I would say US equities participating in the US growth story is a great way to think about deploying that because over the long term, over the next 7 to 10 years, you will find that the US economy will benefit from many trends, the AI proliferation, innovation proliferation, investing in high-end manufacturing industries here. And the millennials are now getting into their prime age of investing, consuming, and earning. That will drive the stock market multiples too. So not being in cash, I think being in cash sort of has a sedate effect and investors feel comfortable, but just participating in that long-term allocations makes the most sense.
I saw you nodding your head,
Yeah,
Michael.
no, and it's, you're 100% right. Time in the market. I'm always public about the idea that the last thing you want to do is short. The last thing you want to do is do cash. And that it's much better to be exposed to a market. Now, the thing is, most people define the market as the S&P 500 or as the Nasdaq.
Sure.
There are many, many different types of markets. So my view is it's better to try to rotate. Hopefully the cycle is in your favor. Talk about AI. If the AI dynamic is real, 3 things probably play out for different markets to invest in. Lower bond yields, it's disinflationary. Small caps running, benefit from the margin enhancement of AI. And you should see utility companies really rocket because AI is going to use a lot of electricity. Those are markets that one can invest in from a very long-term perspective outside of the pure plays of AI that we're seeing right now.
Just lastly, Neil, we think about the higher for longer that we're anticipating from the Fed here as well, and not 5, 6, 7 rate cuts that we might have been anticipating coming into this year, but maybe 1 to 3 on the top end. How does that insert perhaps some fear into this investor sentiment picture right now, and where can we kind of dampen that down a little bit?
Well, first of all, higher for longer is not bad for savers. You make the extra interest income, which you can actually deploy for many things. But I would say that the Fed will cut interest rates. I think it's appropriate for them to cut interest rates because the disinflation trend is ongoing. I think they will be the cutting cycle will be shallow because they don't want to cut too much because they know that inflation can come back in waves like it did in the 1970s. So they will cut because it makes sense for them to recalibrate their rates lower. They don't want real yields to be too high because that just raises the prospects of a recession. So they will cut, and that's why we urge investors to stay invested because earnings are inflecting, interest rates will likely come down, and the AI tailwinds are blowing very strongly.
Gentlemen, thank you so much for taking the time here. Neil and Michael joining us in studio. Appreciate it. Well, we're wrapping up today's show, and I want to tell you what's ahead. Tune in 11 a.m. Eastern Time tomorrow, where we'll talk about your future finances, the impact of early retirement, and how you can still generate income. We'll also break down whether crypto should be a staple in your portfolio. And finally, the importance of alternative assets in a volatile market. And that's not all. We've got more from Tax Time, rates to refunds. Tomorrow, we'll be looking at why the U.S. tax system is so complicated, and here, a sneak peek of what's ahead.
America's tax returns are due in 3 weeks. The government receives nearly $5 trillion of tax refund in a year. IRS will issue close to $650 billion of refund after accepting hundreds of millions of tax returns. But sometimes doing taxes is not so simple. It can get complicated very quickly. How can you file taxes for free? How to get more refunds? And why is the U.S. tax system so complicated? Yahoo Finance's Tax Week 2024 brings you industry news and expert tips on how to do your taxes and really understand what is going on, so you can make the best decision to getting more refunds.
We'll have all that and more when Wealth returns tomorrow. That's it for now. I'm Brad Smith. Thanks so much for watching.